Welcome back to another episode of Investing Explained. Here's today's question. It's actually very timely that we just had Bill Miller here on the show today. With his credentials, we were surprised to hear how he used momentum. And this is something we talked about in the very first episode we had him on, and we'll make sure to link to that in the show notes. But I just wanted to mention that because at the time, it gave us a validation that even as value investors, we might want to look more into momentum. So, Shane, you mentioned that you are a value investor at heart. You basically want to ignore recent price actions, but you're also open to momentum as it might be able to give you a better yield on your investments. So the first method is a very classical value investing approach, and you don't think too much about the price action, whether it's a 52-week low or whatever price metric that you're using. That being said, even as value investors, we can observe certain price patterns that do repeat itself in the financial markets. So why would a 52-week low lead to more lows? Downtrends tend to stay in downtrends for much longer than most people estimate. And the implication is that even though the price to value ratio might be good at that point in time, and you can make a decent profit, you might even be able to enter at a better price, which is what momentum is all about whenever you apply it as a value investor. And this is not to get the lowest of the low when you buy. As I think we all know, it is impossible to predict, but you can stand on the sideline and observe when the market starts having conviction in the stock again, which is when you would start buying too. And another reason for doing that is that we need to respect the efficiency of the market. Yes, you did hear me right. There are actually efficiencies in the market. And very, very often if a stock is suddenly dropping in price, there is a really good reason for it. Please don't make the same mistake that I did whenever I started in stock investing, thinking this is selling at a, say, 52-week low. This is so cheap. That must be because everyone is irrational and I'm the one who is rational. There is typically a very, very good reason why the stock is trading at the price that it's at. So we just really have to be focused on the price and the value again, even as we look at momentum here. Allow me to sum up. You don't have to use momentum as a value investor, but if it's applied correctly, it can give you an advantage.
This is a really great question. I had the same exact reservation about incorporating momentum when I first started learning about it. So the way I personally implement the approach is I apply the same rules for assessing momentum. So what do I mean by that? I guess what I'm trying to say is I don't use technical analysis. I don't do it differently for one company versus another. Instead, I'm looking at a few factors and I'm using those factors very consistently with every single company that I look at. So I'm using long-term volatility to understand when the price is operating outside of its normal range. If I determine that the price is operating outside this statistical range, then the pick gets flagged as a stop loss. If I have a pick with substantial capital gains and it gets that stop loss indicator that the trend has changed or the momentum has changed, I will conduct an assessment of whether it's worth it to sell the company based on the dividends and the yields that I would continue and expect to get, even though I think that the momentum is demonstrating a negative trend. So like Warren Buffett, he's been holding on to Coca-Cola for so long. If that company would come up red for the length of time that he held that, the capital gains that he'd be dealing with, you could make the mathematical argument that even though you expect it to go down and that the momentum trend is bad, because of the purchase price and the capital gains that you'll pay, it might not be advantageous to action the stop loss. Now, if the capital gains on the company are very little or none at all, then it's really easy. If you get the stop loss indicator or the momentum turns red, I sell the pick and I wait for the momentum status to change again if I still believe that the company is a good value pick. In addition to the volatility range of the price, I'm also assessing the moving average of the company. And the length of the moving average completely depends on the volatility of the specific security that we're talking about. So on the buy side, I use momentum as a final validation factor for buying a stock. So let me explain what that means. I find my value picks based on our TIP value filter. This tool is simply, it's just looking at the enterprise value of the company or the price after you account for the debt, and it compares it to the earnings, the profit that the company's making before interest and tax. After I find the pick through that filtering process, I'll do a discount cash flow analysis, or I basically dig into it deeper than just the filtering part. I dig into it. I do a discount cash flow analysis. I determine the intrinsic value of the company. I'm mostly doing this through an IRR-based intrinsic value. And then I finally confirm I'm not catching a falling knife by going back to whatever the momentum status is. So that's my final check to make sure I'm not catching a falling knife.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.